Hello and welcome to January 11th, the second exit of the day, XLE at 190% profit in 8 days. And let's go look at that chart. Lost my cursor. Okay, and there it is. There's the numbers. We got into this trade on the 4th of January. We got out today at 111, and we got in at 248, and we got out at 720. So let's call up our trusted calculator. All right, so 720. Remember, it's a contract. It's 100. And so it will be 720 minus 248 for 472. Divide that by the 248 for a net profit, net ROI, 190. Let's do that again because I got to use my percentage sign. So remember, 720, it's 100 shares for one contract in options, 248. The cost, leaving us a net of 472. Divide that by the 248 as a percentage, and we get, voila, 190. 190. All right, let's go look at the chart now and see what that's set up at. Oh, and let's go ready to get rid of this. Okay, so there's our trade. Now it was we had this dip here, and I set up here, and what I did was slippage. I was anticipating only paying 220, and we got in at 248. So we got in at 248, so that because that's slippage, it happens. It gaps, but it gapped in the right direction. And with that momentum, it just kept on moving. We set the trade up for a 3-to-1 target, and we hit the target at 63.29, and it resulted in the 190 take profit rule. That's the 3-to-1. Now, let's go over the data, and then I'm going to go into what I could have done, what was done right, what was done wrong, and what was done better. Here, it was, the O was 125. So this is a winner's circle. This is a winner's circle win, which is really cool. And that is that this XLE 11, what that means is that I did some trade in the past, and I lost $125. And I kept it separate from the whole. I don't combine all my losses into one trading unit, depending upon whatever the situation is. I think breaking it down makes it easier to enjoy breaking it down by pieces. So the O is 125, and the stochastic is running 98 with an RSI 58. I was not too confident in this trade, but I have discovered that even though you have a stochastic that's very high, the RSI, if the RSI is in the sweet spot, which is usually below 70, then there's momentum that is going to continue. And then look at the volume we had. We had 32.5 volume. So it was one contract at 64 delta, and we're anticipating a 220, as I mentioned earlier, to 248, and the allocation was only 5.8. The option target was 345. That was to overcome that 125. And we were anticipating to be in this trade 10 days, and we got out in 1, 2, 3, 4, 5, 6, plus the weekend, 8. There's 8 days. All right, come down here in the numbers. We saw the 190 you saw in the calculator earlier. One says 472 on one contract, 472 minus $2 in fees, netting 470 on the trade, minus the 125 owed at 345, and this now moves to my winner's circle. So XL11, whatever that trade was I lost on $125, is now off the books, and it reduces my loss leaders down. All right, let's review quickly as of closing minutes here. What did we do right? What did we do wrong? All right, what did we do right? We followed the rules. We set up our entry point. We were willing to accept the loss here, and we took the profit here as soon as it hit. I mean, who's to say that this is going to continue? We don't. But could have. We could have gone last bar. Let me go ahead and finish with what we did right. Okay. The other thing, what else we did right? Well, we followed the rules. As soon as this cleared, I call it clear the entry point, I call it like clear the gantry. I do a calculation of the option cost. So this is 248. And I'll go ahead now, and I'll go 248. And I'm willing to lose 30% because the gap posits can be it could be as much as maybe for 35 or 40, but it stays with under the 50% risk management. and it says at 173, I could call it 173.4 or 173. So I would then go into my order ticket and say that if this option price off the ticker symbol from the option falls below 173, I'm out of the trade. And that's why protecting it, to try to keep within your 30% risk management rules. But it never happened. It just took off. It's just like, boom, gone. So now what could we have done? What did we do wrong? Nothing. We follow the rules. Once you set your rules up, just follow the rules. Keep consistent. What could we have done better? What we could have done better is that it says that if it touches anywhere near the third ratio, then chase it up, especially if a good strong candle, not a doji, but you had a nice good strong candle like this with with some kind of wick on the bottom and nothing on the top, then I could have gone last bar low and then gone up in here, maybe get out somewhere up here. Maybe. Remember, we don't have a crystal ball. And I have been, in my past experience has been, when you have a profit, a substantial profit, take it off the table, because trading is a poker game. And everybody puts the money into the ante, which is you buying into the option, buying into your trade. And when it gets to a profit that you're happy with, grab it, because the next person next to you is going to grab it. And then it's going to leave you holding the bag, losing maybe 20, 34% off that profit. So that is it for there. What's our next thing? Now, this was a winner's circle, so this will not be up. This will not get traded again. Well, I do have other XLEs that owe me. So XLE 1, 2, 3, or 4, whatever. We will go to the chart and see which one owes the least, and that goes up front. Well, that is a conclusion of today's report for XLE at 190% profit in 8 days. Please drop me a comment, subscribe if you found some value in this, and let's see you in the classrooms at OTA Irvine. A shout out to my counselor, Dennis Cervantes, and out to the director, Andrew Dominguez, and my instructors from the past and the present. Larry Jacobson is there. Robert Dunn is there. Jeff Manson is there. I mean, I have a lot. With that, let's call it quits for tonight. And thank you very much for stopping by and checking that out.